Greetings and welcome to HouseLux Estate, your go-to online resource for all things related to housing, finance, and savvy living. We're here to guide you through the labyrinth of personal finance, offering practical advice and actionable strategies to help you make the most of your money. At HouseLux Estate, we focus on empowering everyone, especially those with low income, to navigate the often daunting world of housing and budgeting. Our mission is to demystify complex financial concepts and provide you with easy-to-understand yet effective strategies. We believe that with the right information and tools, everyone can achieve financial stability and even prosperity. So whether you're trying to save for your first home, plan for retirement, or simply stretch your paycheck further, you've come to the right place. In today's video, we delve into the world of taxes and share some effective strategies to reduce your tax burden. Before we delve into tax reduction strategies, it's crucial to have a basic understanding of taxes. So what exactly are taxes? In the simplest terms, taxes are mandatory contributions that individuals and corporations pay to the government. They are the primary source of revenue for the government, which it uses to fund public goods and services such as roads, schools, and healthcare. But why are taxes so important? Well, they form the backbone of our economy. Without taxes, the government wouldn't have the funds to maintain infrastructure, provide social services, or invest in the development of the nation. They also help regulate the economy by controlling inflation and unemployment. Now let's talk about how taxes are calculated. The amount of tax you pay is based on your taxable income, which is your total income minus any deductions and exemptions. This taxable income is then divided into chunks or brackets, each of which is taxed at a different rate. Now, it's important to note here that the tax system in most countries is progressive. This means that the tax rate increases as the taxable income increases. So, the more you earn, the higher the percentage of your income you'll pay in taxes. But don't panic yet. The progressive tax system doesn't mean that all of your income gets taxed at the highest rate. Instead, different portions of your income get taxed at different rates, depending on the bracket they fall into. For instance, if you're a low-income individual, only a portion of your income will be taxed, and that too at a lower rate compared to high-income individuals. This is where the concept of marginal tax rates comes into play. The marginal tax rate is the rate at which your last dollar of income is taxed. It's this rate that increases with income, not the rate on your entire income. With this foundation, we can now explore some strategies to reduce your taxes. Our first strategy involves making the most of tax credits available to you. Now, tax credits are not just a reduction in the amount of taxes you owe, they're also a way for the government to incentivize certain behaviors that are seen as beneficial to the community as a whole. One of the most well-known tax credits is the Earned Income Tax Credit, or EITC. Designed for low to moderate income working people, the EITC can provide a significant reduction in the amount of taxes owed, and in some cases, may even result in a refund. Another tax credit to consider is the child tax credit. If you're a parent, this could be a golden opportunity to reduce your taxes. For each child under 17, you can claim a credit that can significantly lower your tax bill. There's also the American Opportunity Tax Credit, which is geared towards students. If you're pursuing higher education, this credit can help offset some of the costs, making it a bit easier on your wallet. The key here is to understand that these credits are there for you to utilize. They're not just numbers on a paper. They're real, tangible benefits that can make a huge difference in your financial situation. It's all about knowing what's available to you and taking advantage of it. Utilizing these tax credits can significantly reduce your tax bill. It's a strategy that's not just about saving money, but also about improving your quality of life. Opening. The second strategy centers on retirement planning. All right, let's talk retirement. It might seem far off, but the sooner you start planning, the better off you'll be. And here's the kicker. Contributing to retirement accounts can actually help reduce your taxable income. How does that work, you ask? Well, when you contribute to retirement accounts like a 401k or an individual retirement account, also known as an IRA, these contributions are often tax deductible. That means the money you put into these accounts is subtracted from your income before taxes are calculated. So you're effectively lowering the amount of income that's subject to tax. Now, you might be thinking, but I can't afford to put money away for retirement. And that's a valid concern. But remember, every little bit helps. Even a small contribution can grow over time thanks to the magic of compound interest. and the money you save on taxes today could help offset the cost of those contributions. On top of that, some retirement accounts like Roth IRAs allow your investments to grow tax-free. That means you won't pay taxes on the money when you withdraw it in retirement. It's a win-win. Just remember, these are general principles. Everyone's situation is different and tax laws can change. So it's always a good idea to consult with a tax professional to make sure you're making the best decisions for you. Closing. So, investing in your future not only secures your retirement, but also helps you save on taxes today. Our third strategy focuses on taking advantage of education-related deductions. Education is an investment in your future, and the government recognizes this by offering a variety of tax deductions related to education expenses. These deductions can help reduce your taxable income and thereby lower your overall tax bill. One of the most common education-related deductions is the student loan interest deduction. This allows you to deduct the interest you've paid on your student loans during the tax year. It's important to note, however, that there are certain income limits and other qualifications you must meet to be eligible for this deduction. Additionally, there are other education-related deductions and credits that you might qualify for. The Lifetime Learning Credit, for instance, can be claimed for qualified tuition and related expenses, while the American Opportunity Tax Credit offers a credit for the first 4 years of higher education. These deductions and credits are not just for those pursuing their own education. If you're a parent paying for your child's education, you might also be eligible for these benefits. Remember, every dollar you can deduct from your taxable income is a dollar that's not being taxed. So, by investing in education and taking advantage of these deductions, you're not only investing in your future or your child's future, but also making a smart move to reduce your tax bill. Investing in your education or your child's education can therefore be a smart tax-saving move. Let's wrap up what we've covered today. We embarked on a journey to understand the intricacies of taxes and how to navigate them in a way that benefits low-income individuals. We've seen that taxes aren't as daunting as they may seem, and with a few strategies up your sleeve, they can be managed effectively. Firstly, we talked about the importance of understanding taxes. We discovered that taxes are more than just a mandatory contribution to state revenue. They are a tool we can use to our advantage if we learn how to navigate the system. We learned about the different types of taxes, how they're calculated, and the importance of filing correctly and on time. Our exploration of tax credits was our second stop. We shone a light on the various tax credits available, such as the Earned Income Tax Credit, Child Tax Credit, and others that can significantly reduce your tax obligations. We stressed that it's crucial to be aware of these credits and to claim them if you're eligible, as they can make a substantial difference to your tax bill. Then we delved into the world of retirement accounts. We discussed how contributing to retirement accounts like a 401k or an IRA can reduce your taxable income now and provide a nest egg for the future. It may seem daunting to put money away when finances are tight, but remember, even small contributions can add up over time. Our final strategy was all about education. We highlighted how education expenses such as tuition and fees for yourself or a dependent can be deducted from your taxable income. We emphasized that investing in education is not just a personal development tool, but also a tax reduction strategy. So, there we have it. A quick tour through the world of taxes, exploring strategies aimed at reducing your tax bill. Remember, understanding your taxes, utilizing available tax credits, contributing to retirement accounts, and deducting education expenses are all steps you can take to manage your taxes more effectively. It may seem like a lot to take in, but with a bit of time and effort, you can turn the tide in your favor. Remember, every little bit of saving counts. Thank you for joining us at House Lux Estate. Don't forget to subscribe for more valuable tips and strategies. Until next time, stay savvy.